Good morning, traders. Richard here from Underdog Investments. Today we're going to be speaking about the holy grail of trading, and that's expectancy. You know, the reality is, and we've all heard this as we've gone through our trading journey, there's no one perfect system, there's no one perfect indicator that's going to guarantee profitability in this game. But what I do regard as the true holy grail is this concept of expectancy, and more importantly, positive expectancy. So I'm going to run the disclaimer now, and then we're going to jump in and try and unpack what all of this means. Okay, so when we refer to expectancy, there are a few variables that go into this formula, and it's very important that during the course of your trading, in whatever format, be it in a trading journal, a hard copy journal, an Excel spreadsheet, whatever the case may be, that you actually track this information in respect of your trading. And the more data you have, the bigger your sample size when tracking these variables, the more reliable they're going to be, and the better the information you are going to get out at the end of the day is going to be. We'll get into that later. Let's run through those variables. Firstly, win rate. Very simply put, how often are your trades winning trades? If you've got 100 trades and 40 of them are winners and 60 of them are losers, then you've got a 40% win rate. If you've got 100 trades and 70 of them are winners and 30% of them are losers, you have a 70% win rate. That's the first thing you need to track. Secondly, reward to risk. This is the ratio of your average win size per trade to your average loss size per trade. So if you win on average 20 Rand or $20 per trade, and you lose on average 10 Rand or $10 per losing trade, you have a reward to risk ratio of 20 to 10 or 2 to 1. Frequency. Frequency refers to the number of setups that you get in a particular month. Very often this element of expectancy is ignored in expectancy formula, and the reason it's important is that you can have a system with a great win rate, 90% win rate, 9 out of 10 trades win. It's got a excellent reward to risk ratio, 4 to 1. For every 10 Rand or $10 you risk, you win 40 Rand or $40, but you only get one trade set up in a month. Now that's great, and you know you're going to have a system with a great expectancy, as you'll see later on, but it's not going to generate you a lot of money over time. So an important variable in the expectancy formula, which we're going to look at, is going to be the frequency. How many trades do you actually get in a particular month? And then lastly, risk factor. You know, we're dealing with historical data. We're dealing with the human element of execution for the most part when we're doing our trading. So what the risk factor is essentially an adjustment we do to our expectancy to reflect the risk of error, for want of a better word. But it's also, you know, you can have errors in terms of your trading. So you do the wrong trade at the wrong time. You can have trade slippage. You execute the trade at price A, but by the time that the trade executes, the price has moved to B, and you've got a variance between those two prices. So the risk factor that we're going to apply here is really the thing that gives you a wiggle room in terms of your understanding your own trading expectancy. But we'll unpack that when we get into a live example. So what is the formula? What is the Holy Grail? Here it is. Don't worry about the mathematics of this thing. We'll, as I said, we'll unpack this when we look at a live example. But it's expected value is win rate multiplied by your reward to risk less 1 minus your win rate multiplied by your frequency multiplied by your risk factor. And the only important thing here is that your expected value must be positive. You cannot have a negative expected value system. It's not going to make you any money. So expected value is your win rate multiplied by your reward to risk less 1 minus your win rate multiplied by your frequency multiplied by your risk factor. Let's look at a live example. So what do we have here? The HA system is a intraday trading system that we actually use at Underdog Investments in a live environment. And what I've pulled here is really the data from the past 3 months. So this is May, June, July of 2016. I've pulled the variables that we're going to use in our expectancy calculation. So let's run through those. Firstly, you can see here we've had 39 winners and 38 losers. So 77 trades in 3 months, of which 39 are winners, giving us a win rate of 51%. I'll speak a bit later about whether or not that's good or bad. Secondly, reward to risk. On our winners, for each winner, so per trade, we've won an average 1.3 units of risk per trade, and on our losers we've lost 0.85 units of risk per trade. 1.3 divided by 0.85 gives us our reward to risk ratio of 1.53. I'll come back to what risk units entail, but just bear in mind that to calculate your reward to risk, it's your outcome per trade for your winners divided by your outcome per trade for your losers. That gives you your reward to risk. Frequency. Well, we've had 77 trades in 3 months, so on average, that's 77 divided by 3. We're doing about 26 trades per month, or if you like, just over 1 trade per trading day. And quality, I'll put that in at 80%, and as I said, this gives you your wiggle room. What this is saying is that yes, we've got these 3 variables here, and it's based on either back testing or historical live trading data, but going forward, I only expect, and you can play around with this number, I only expect the execution of my trading to be 80% of, from a quality perspective, to be 80% of what it's been in the past. So I've given myself, I've said there's about a 20% efficiency in my trading going forward. I'll speak a bit more about this when we talk about optimization. I then apply my formula. Expected value equals win rate multiplied by reward to risk less 1 minus win rate multiplied by frequency multiplied by risk factor, using those 4 variables, and I get an expectancy of 5.77 per month. What does that mean? Well, let's go back to the concept of outcomes per trade. And I said risk units per trade is how we look at these outcomes per trade. And what is a risk unit per trade? What does 1.3 on each winner mean? Well, what does 1 mean? Essentially what this comes down to is, and we're not going to go into the full detail of this, it comes down to the concept of money management and how much we are risking on each individual trade. When we get into a money management discussion in future videos, I'm going to speak about the kinds of the parameters we put around how much we risk per trade. But let's, for example, assume that we've got a 50,000 Rand account and we are risking 1% of our capital on each trade. 1% of 50,000 Rand is 500 Rand. So what we're doing here now is each unit of risk is essentially 500 Rand, and our expectancy is 5.77 units of risk per month. So in other words, let's work that out. 500 times 5.77, 2,885 Rand per month. That's our expectancy using a 50,000 Rand account and risking 500 Rand or 1% of that account per trade. If we were using a million Rand account and we were risking 1% of our capital per trade, 1 million Rand multiplied by 1% gives us 10,000 Rand. Our risk per trade is 10,000 Rand, which means our expectancy in this formula, or in this example, is 5.77 times 10,000 Rand per month. So the risk per unit, or the expectancy, is really fluid from a monetary point of view, depending on how much you're risking per trade, and that in turn is dependent on how big your trading capital account is. Now, does this mean that for each and every month you will earn 5.77 multiplied by however much you're risking per trade? No, it doesn't. Because as we all know, trades don't follow any particular defined distribution. You can have 1 winner, 2 losers, 5 winners, 3 losers, 10 winners, 20 losers, that kind of thing. So it doesn't mean that each and every month you're going to be generating 5.77 units of risk as profit. What it does mean is that over time, given enough time in the market, your system has a positive expectancy, and your expectation is that on average you will generate 5.77 units of profit per month. The other important thing to remember, and I touched on it earlier, is the number of trades, or your sample size. The more trades you have here, 77 is a minuscule sample. 3 months is a short period. If you manage to, from historic, from back testing or time in the market, to get a 12-month sample, to get a 24-month sample, to get a 5-year sample, to be testing this over 500 trades, over 1,000 trades, what you'll find is the expectancy number that is calculated here moves closer to the reality of what that expectancy is going to be. So the bigger your sample, the better, the more accurate your expectancy calculation, and the more confidence you can draw from that expectancy calculation. So, what are the takeaways from this video, or what I'd like you to take away from this video? First and foremost, positive expected value equals long-term profitability. So again, it doesn't mean that we're going to make profit tomorrow, doesn't mean that we're going to make profit even this month. But over time, if we have a positive expectation from our trading system, we are going to be profitable. And then, rather than focusing on the profitability of each individual trade, or getting ourselves all tense in terms of whether when we've had 2 or 3 or 4 losing trades, what we want to be doing is we want to be focusing on optimizing the variables in our formula. So let's go back. These are the 4 variables in our expectancy formula. And all we want to be doing is we want to be focusing on optimizing those variables. So when we're looking at the quality of our execution, we want to be making sure that we are maximizing that quality, reducing the amount of slippage where we can, reducing the amount of errors. Track that statistic on a monthly basis and understand how effective you are in the execution of your system. Where are we making mistakes? Try, if you're making mistakes in a particular area, try and identify what the theme is. What is the theme of the mistake that's being made, and try and address it going forward in your trading. So the more we improve the quality of our trading, the better our expectancy is going to be. Frequency, I've touched on that. You need a trading system that gives you enough time in the market. There's absolutely no point to having a trading system which generates 1 trade per month, even if it has a really good positive expectancy on an individual trade basis. Why? Because unless we are risking a huge chunk of our capital per trade, it's just not going to generate enough money for us. Win rate. This is actually an area that most traders focus on heavily, in fact excessively so. Everybody wants a system that's going to give the maximum win rate. So 9 out of 10 trades are going to be profitable, 8 out of 10 trades are going to be profitable. What you have to do is you have to balance your win rate with your reward to risk, because very often what you'll find is that the 70, 80, 90% win rate systems have a lower average reward to risk outcome. So you want to balance these 2 variables. What I try and do is I try and make sure my win rates, or for my systems that I use, are between 40 and 60%. If you go too high, 70, 80, 90%, you lose too much on the reward to risk, is my finding. If you go too low, 30%, 20%, even if you have a great reward to risk, what you'll find is the decay in the emotional capital of, on average, losing 8 out of every trades you do is just going to overwhelm you, and it's going to lead to more errors. It's going to reduce the quality of your execution. So try and take a balanced view when you're looking at a win rate. Similarly, reward to risk. Some people trade as low as a 1-to-1 reward to risk. What I like to do is I like to have my reward to risk. In fact, this number here based on the sample is quite low. I like to be between 1.5 and 2.5 on my average reward to risk ratios. Below 1, where you're what you're getting into is an inverted risk to reward or reward to risk scenario, where you are, for example, risking 10 Rand to make 8 Rand kind of thing. That is also not a healthy place to be in terms of your overall trading system. So try and find the right balance in that fits in with your own trading, call it philosophy or trading style, the way you can deal with trades from an emotional perspective. Try and find the right balance between reward to risk and win rate. And then, as I said, the bigger the sample, the greater the confidence. You don't get a hell of a high level of confidence from 77 trades. But if you had 1,000 trades and it was telling you your expectancy is 5 units of profit per month, that really gives you a much better sense of confidence in your own positive expectancy. Guys, that's pretty much it from the expectancy point of view. As I said, the next step, and we'll try and deal with that in the next video, is going to be around money management, how we put together a money management plan around our trading, how we deal with drawdowns, because at the end of the day, the expectancy side of the equation, what I call the holy grail, is going to tell you whether or not what you're doing is profitable. The money management side of the equation is going to give you the opportunity to continue to be in the market, to continue to apply that positive expectancy in your trading business. I hope that was useful. Quite a short video, but if you have any comments or questions, drop me a line. I can be contacted through our website, www.underdoginvestments.co.za, or send me an email, richard@underdoginvestments.co.za.